Welcome to Understanding the Regulatory Environment. To begin, click to choose your game piece. To move through the course, use the left and right arrows at the bottom of the screen. You can also stop or replay any screen with the Stop Play button. Move your cursor over any highlighted words for additional information. Click Next to begin. Utilities operate in an environment governed by rules and regulations. Ameren is regulated by agencies in Missouri, Illinois, and the federal government. Operating in this highly regulated environment means we have to work within the regulatory guidelines to provide the best return for our investors, the best services for our customers, and a sustainable business for coworkers. These regulations impact our decisions on what, when, and how we spend money. In fact, our profitability is actually determined by how we manage our costs and providing services in a cost-effective manner. Sound intriguing? In this course, we'll explore why utilities are regulated, how regulations work, and the impact it has on our business decisions. Let's first learn why utilities became regulated and discuss the different types of utilities we have today. Utilities are natural monopolies, meaning they provide an essential service for the well-being of society, and the industry's cost structure makes it more economical and feasible for one company to serve an area rather than many smaller ones. Without exclusive territories, our towns might be jungles of pipes and wires from competing companies. This led to the system we know today. Utilities serve defined territories, and their service is regulated, along with their rates. Although a natural monopoly, utilities aren't one-size-fits-all. Most are investor-owned, like Ameren. In fact, 3/4 of Americans are served by investor-owned utilities, owned by private stockholders and operating as for-profit businesses. Most of the remaining 25% of Americans get their power from a municipal or a cooperative, both not-for-profit entities. Finally, some customers get their power delivered through one of 9 federal agencies, such as the Tennessee Valley Authority. Drag and drop your game piece on a menu item to learn more about investor-owned and consumer-oriented utilities. A rural electric cooperative or co-op is owned cooperatively by the customers of the utility, who are considered members of the co-op. Prices are regulated by a board of directors. Many co-ops were formed during the Great Depression to extend electric service to rural areas that investor-owned utilities were unable to serve. Drag and drop your game piece on a menu item to learn more. Municipals or munis are owned by a municipality and operated as a department of that city or town. The local city council or elected commission governs and provides oversights, including setting rates. Drag and drop your game piece on a menu. Ameren is an investor-owned utility, trading on the New York Stock Exchange. In fact, we're among the nation's largest investor-owned electric and gas utilities. Many utilities, like Ameren, are organized as holding companies, with multiple subsidiaries serving one or more states. Also, like Ameren, many of these utilities serve electric or gas customers, or both. However they're structured, all utilities must continually make new investments to replace aging infrastructure, or add facilities to serve new customers. For munis and co-ops, this funding may come through tax-exempt bonds. For investor-owned utilities, funding comes from various sources. They can issue stock, selling shares to investors, or borrow money. Then, there are retained earnings, the money left after dividends have been paid to investors. Let's focus on investor-owned utilities like Ameren. Left unregulated, a monopoly can control services and set prices at will. For utilities, this could lead to restricting who gets energy or setting prices that can't be justified economically. This is where government regulation enters the picture. In exchange for the exclusive service territories, utilities agree to be regulated. This regulation protects the public interest. It balances the interests of the customer and the company. As a regulated utility, we have certain obligations. We have to serve all of our customers on equal terms. We need to provide electric and gas to everyone who requests and can pay for the service based on the price established by regulators. This price has to be just and reasonable. And our service needs to be safe, reliable, and adequate. This requires a balance, operating in a highly regulated environment and being profitable to attract investors. Our earnings have to be enough to reinvest in improvements and pay dividends to our shareholders, who supplied the money to make those improvements. With 64,000 square miles to serve, it takes a lot of funds to build infrastructure, repair equipment, and install smarter technologies. If a town is adding homes and businesses, we may add pipes, wires, poles, and a substation to power them. Let's say that costs $1 million. To finance it, we might borrow half the funds and raise the other half by selling stock. Those who buy the stock, our shareholders, are equity investors. Unlike most businesses, we can't simply raise prices to finance projects. When costs change for a gas station owner, he simply changes his price. However, to raise prices, we need the regulator's approval. This continues our balancing act. Regulators have to approve a change in price or rates to allow the utility to recover increased costs and to earn a reasonable return on the capital we have invested to improve our system and help ensure safe and reliable service. Let's examine how prices are set in this regulated environment. Ameren has to plan for the future. To achieve long-term success for the company, we must invest in and maintain our system. We have to ask and answer, what are our current operating and maintenance costs, and how will those change in the future? Which technologies are good investments to grow? How can we create stability to show lenders we're a good credit risk? What can we do to make our stock attractive to investors? Finally, what is a fair rate to charge customers to do all of this? For this last question of rate, the final answer comes from regulators. Operating in a regulatory environment means we must get the okay from regulators to adjust rates. The goal is to get a fair rate of return on our rate base. To help understand how this works, let's step back and talk about renting a house. John plans to rent a house. The question he needs to answer is, what can I fairly charge for rent? To do this, he first has to consider his expense, the costs related to owning the house. We'll call that his revenue requirement. To calculate the revenue requirement, he adds up the cost of loan payments, insurance, general upkeep, and paying someone to mow the lawn. He includes an estimate for a new roof he believes he'll need in the next year. This ends up being $1,000 a month. He also adds in a small profit to make it financially worthwhile to own the house. His ownership needs to have financial integrity, but his profit has to be reasonable. He evaluates the rent for similar houses in his area. If he makes the rent too high compared with those houses, it's not likely he'll find someone to rent his house. In essence, the marketplace regulates rent. He decides on a 10% rate of return, or $100 a month. So he considers all his costs, his revenue requirement, a profit, a fair rate of return, the local market, what's fair and reasonable. He then matches that to the revenue. For him, this is rent over the course of the year. He decides $1,100 a month for rent, or $13,200 for the year, is fair and reasonable. Sally rents the house, signing a 1-year lease. While determining rates for a utility is far more complex than renting a house, the overall process is similar. The regulator's goal is to match the expense to the operating revenue for the period in which the rates are in effect. This is called a cost of service approach. Regulators consider the revenue requirement, a fair rate of return, and what's fair and reasonable. To determine our revenue requirement, we look at how much money is needed for simple operating costs, materials, labor, repairs and fuel, depreciation of assets, and taxes. Then we also include the return on our rate base. This has two parts. One is debt, or the interest expense on money borrowed to finance the plant and equipment. The other is the return on equity, or ROE, what we pay our shareholders. The ROE is also a component of the fair rate of return. For ROE, one thing that regulators look at is the return of similar enterprises with similar risk as a utility. This compares to how John looked at rents for similar houses in his market. And as John needed to make a return so that his ownership of rental property has financial integrity, regulators also factor that in. They consider that the return has to be sufficient for the company to show financial integrity, allowing us to keep the company viable so that we can borrow money and be a valued stock for investors. So, although it is more complex, in the simplest terms, the regulators set rates using the same type of information John used to calculate the rent for his house. Now, if John had additional buildings, an apartment building, an office building, he'd have a different rent for each type of customer. Likewise, regulators look at each class of service, residential, commercial, and industrial, and the energy each uses. They then determine fair rates to charge each of those consumers. We've shown how matching expenses and revenue is used to set rates. However, all of this is complicated by a concept called regulatory lag. To explore this, let's go back to John's rental business. John's rented the house to Sally for 1 year. In a perfect world, the $13,200 John receives in rent will match what's needed to cover his costs and give him a small profit. But the expense side of the matching is an estimate. The revenue is the actual dollars Sally will pay John. Whether all costs are covered and John earns a profit depends on the accuracy of his calculations, and if nothing beyond his control impacts those costs. If the expenses and revenue don't match, John will experience a lag before he makes back any extra costs he's incurred. Let's look at 3 possible scenarios. In our first scenario, John's calculations, including the cost of the new roof, were fairly accurate. The only unanticipated expense was a small increase of $300 by the lawn service to mow the grass. He's been able to pay those costs and earn a small profit, or rate of return, based on the rent, his revenue. So he's had a very low lag. It's likely in the next year he'll be able to recover that small amount of additional expense with a small raise in the rent. In a second scenario, the cost of the roof was lower than John's estimate. Insurance paid for the new roof following a hailstorm. Here the lag has worked in his favor. His rate of return is higher than he anticipated. Finally, let's say when replacing the roof, extensive water damage was discovered that drove the cost of putting on the roof much higher than his estimate. When actual costs significantly exceed estimates, the lag has a fairly significant impact. John can't raise the rent mid-year to get additional money to pay that extra cost. He'll have a lag in time before he can recover that money. In fact, he may not be able to raise the rent significantly in the next year to keep it at a fair market level. So the lag in time before he can get back enough in rent to recover the increased cost of the new roof may be several years, or he may never recover those costs. Under traditional regulation, we experience the same impact with what's referred to as regulatory lag, the difference between when costs are incurred and when those costs are included in the rates. Essentially, rate increase authorized by regulators will lag behind changing costs. One would need a crystal ball to have rates reflect dollar by dollar the current level of operating costs. Just as John could only estimate the cost of the new roof, we can't predict with 100% accuracy our revenue requirement. If costs do go down, all things being equal, regulatory lag works in our favor. When revenue requirements are lower than estimated, the revenue generated more than covers those costs. However, if costs are increasing, again, all things being equal, regulatory lag usually works against us. Regulatory lag can be relatively high, or its impact can be low. When high, rapidly rising costs, the need to invest in improvements, or the need to comply with environmental rules means we may have to wait months, even years, to start earning returns. That's if we can ever recover that money. Like John, we can't simply raise the rent to cover additional costs. The impact of regulatory lag, whether it's high or low, will vary based on the ability of the utility to project its cost of service and whether the regulator agrees with the utility. Ameren operates under 3 regulatory agencies: the Missouri Public Service Commission, the Illinois Commerce Commission, and the Federal Energy Regulatory Commission, or FERC, which regulates wholesale electric power and electric and natural gas transmission. Each commission uses a specific method, either a test year or formula rate, to determine the revenue requirement and what we can charge customers. Each one looks at expenses and returns, but in a different way. The regulators want to make sure the utilities' operating and investment decisions are prudent. Are they practical, and do they make sense? A test year is a snapshot of costs over a 12-month period. Regulators view the year as representative of the cost and revenue required in the year those new adjusted rates will be in effect. A test year may be for a historical period, or a future or forward-looking period. However, all expenses incurred by the utility aren't allowed to be counted. These include some advertising and marketing costs and lobbying costs. Although not allowed, all are a part of the cost of doing business. Because these aren't added in the test year, and so not calculated as part of the rate, they're simply a permanent loss of return to the shareholder. It's as if John couldn't consider the cost of advertising on a real estate site when calculating his expenses. That's simply money he can't recover in the rent he charges. Drag and drop your game piece on a menu item to learn more about each method. Missouri uses a historical test year in its rate proceedings, looking at the past to predict the future, a rapidly changing future. The historical test year starts with actual expenses. Then those expenses are adjusted if there is some change in costs and sales that we know about and that can be measured. A challenge in using a historical period is how quickly things can change. Large infrastructure investment needs, rising costs, and lower than historical sales growth all impact the revenue requirement. In Missouri, to increase rates, a rate case must be filed and a determination made by the Missouri Public Service Commission. Also, while electric transmission is regulated by FERC, when setting rates, the Commission does include transmission costs in the retail rates it approves. In today's environment of lower sales and increasing costs, what do you think the impact of regulatory lag is when using this method? Click and drag the green bar to indicate the potential impact of regulatory lag when regulators use a historical test year. The correct answer is a high level of regulatory lag. When using a historical period, rates can quickly become outdated, which can increase the amount of regulatory lag. With this method, you have the greatest time lag between when costs are incurred and rates are established. This is especially true if we place new assets into service in between rate cases. This would be as if John learned his house needed new windows right after Sally signed a lease. Another reason for high lag in Missouri is the fact that it can take up to 11 months to resolve a rate case. Drag and drop your game piece on a menu item to learn. A forward-looking or future test year uses projections for expenses, investments, and sales. This method is used by Ameren Illinois' gas business. Because estimates are based on future predictions of costs, especially capital investments, we need to be good at forecasting our capital investments, operating costs, and customer usage. John used a forward-looking year on calculating his rent as he included the cost of the new roof. A projection still presents a challenge. You can't predict unforeseen circumstances that will impact the numbers, just as John didn't realize his house had water damage. Utilities must also establish a track record for the credibility of their forecasts. For Illinois Gas to increase rates, a rate case must be filed and a determination made by the Illinois Commerce Commission. What do you think the impact of regulatory lag is when using this method? Click and drag the green bar to indicate the potential impact of regulatory lag when the correct answer is a medium level of regulatory lag. Even with challenges, using a future test year can help reduce regulatory lag. Drag and drop your game piece on a menu item to learn more about. The formula is established through a regulatory or legislative process. The formula is then populated with either projected or historical costs to set the rate. Once established, formula rates usually make the process to establish new rates easier and less contentious compared with using a test year, either historical or forward-looking. This method is used by Ameren, Illinois' electric distribution business and FERC-regulated transmission business. In Illinois, regulators use a specific formula tied to the interest rate on 30-year Treasury bonds to calculate the ROE. While a rate case needs to be filed for an increase, using this calculated rate of return means that the most contested part of the case is simply removed from the proceedings. The FERC regulatory model for transmission rates is a little different in that it uses a formula rate and a fixed ROE. To encourage the construction of transmission, the FERC ROE is typically higher than the Illinois and Missouri allowed ROEs. The FERC model is also the most straightforward. It involves the use of a formula rate with annual updates to reflect changes in the inputs to the formula. Interested parties may challenge aspects of the formula rate, including whether the underlying costs were prudently incurred. What do you think the impact of regulatory lag is when using this method? Click and drag the green bar to indicate the correct answer is a low level of regulatory lag. For this reason, now that you've learned about each method, let's see how a rate case works in Missouri, where a historical test year is used. It's considered a legal proceeding filed with the Missouri Public Service Commission. To present our case, we tally the costs of providing energy, like materials, labor, taxes, interest, fuel, depreciation, as well as a fair return on our equity investment. We then provide this information to regulators in a formal filing called a rate case. Regulators review all of the facts of the case and then set the rates we charge, which include the rate of return we can earn. During the proceedings, Ameren presents witnesses. Others can as well, such as commission staff, consumer advocates, and other interested parties referred to as interveners. These other parties address specific issues of concern or interest to their constituents. Their witnesses provide evidence on issues impacting the company's costs or operations, including establishing a fair ROE. In addition to internal company witnesses, Ameren, Missouri typically hires an outside consultant to address issues such as ROE or depreciation studies. In one rate case, witnesses for the company and the other interested parties each supported a different ROE. The Commission finally found a rate of 9.8% to be fair. As you can see from this example, there are no guarantees regulators will approve our request. It's easy to see why utilities, including Ameren, prefer regulators who use formula rates. Having that calculated rate of return takes out the complexity of a legal proceeding and helps reduce regulatory lag. If the regulatory framework fairly and reasonably looks at rates and ROE, we have more timely cash flows. This in turn helps us make more timely investments in upgrades and new technology. Next, let's see what Ameren can do, regardless of the method, to reduce the impact of regulatory lag. We know that regulatory lag is the difference between when costs are incurred and when those costs are included in the rates. What you actually earn can differ from the allowed return due to regulatory. One way we work to reduce the impact of regulatory lag is with mechanisms allowed by regulators called riders and trackers. Riders allow you to change rates by filing what is called a prudence review. This is not a full-blown rate case. It's as if John had a clause in his rental agreement that the rent could be evaluated and changed during the course of the lease. Riders are used predominantly in Illinois. In general, in Missouri, riders require the passage of legislation. Trackers allow us to track costs that are different than the amount included in rates. These costs can then be included in future rate cases and so can be recovered. It's as if John could track the specific cost of maintenance on the house and determine if it goes over his estimates. Trackers are predominantly in Missouri, where the okay to track costs can be granted by the Missouri Public Service Commission. One of the most important ways we can influence the impact of regulatory lag is with our decisions on the timing of spending. It can be a negative influence if we increase our expenses above those used to calculate the rate, or if we invest too quickly in new plant or technologies. On the other hand, we can reduce regulatory lag if we work to make our revenue requirement, operations, maintenance, and capital spending better align with the decisions made by regulators and economic conditions. It's a delicate balance. We have to focus on spending the right amount at the right time on the right things so that we can recover our costs, earn a reasonable return on the capital we have invested, and invest more to keep the lights on and the gas flowing today and into the future. We've covered a lot of material: the types of utilities, how regulations govern our rates, and the concept of regulatory lag. Let's now see how regulations impact our decisions on what, when, and how we spend money. Evaluating the regulatory requirements frameworks for each type and location of our business plays an important part in Ameren's business decisions. Our strategy is to invest where these frameworks are most favorable, while always providing safe and adequate service to our customers. We consider where we'll most likely have the highest returns and the lowest amount of regulatory lag. This approach yields the best opportunity for our shareholders to receive an adequate return on their investment in our company. On the basis of what you've learned, select the type of business where Ameren would want to invest the most capital. Did you answer correctly? The type of business where Ameren would want to invest the most capital is FERC electric transmission. Remember, we initially stated that our profits are determined by how we spend our money, not what we sell. As a regulated business, where you're allowed to earn the best rate of return is where you'll have the highest earnings. Our growth strategy is to focus investments in the electric transmission business to take advantage of the higher authorized ROE and a less contentious regulatory process. Plus, future transmission investment opportunities. Utilities are natural monopolies by virtue of the essential services they provide and how that service is delivered. By establishing exclusive service territories, the industry was able to eliminate the potential jungle of wires and pipes in a town by competing providers. In return for these exclusive service territories, utilities are subject to state and, at times, federal regulation. Various commissions that govern where we do business and set our rates. Our transmission business offers the most favorable returns and biggest potential to expand. At the federal level for transmission, FERC sets the rate and fair rate of return, which historically have been higher than those rates set by the states. By investing our money in transmission, we're best positioned for the future. Here's a list of available resources. Congratulations! You have successfully completed this course. To get credit, you must click the exit button in the upper right corner.